Not every order block works, but learning flips helps you uncover the strongest trade opportunities. A real order block flip is the moment the market shifts control from one zone to the opposite zone. And that shift often reveals the strongest setups on the entire chart. In this lesson, I will show you how to identify a true flip, and more importantly, how to use it to unlock more high-probability opportunities. Let's begin. Section 1. What a flip really is. A flip occurs when the market invalidates the previous structure's intention and immediately shifts the order flow in the opposite direction. A true flip has three essential components. 1. Mitigating an order block. 2. Failure of that order block. The zone is broken with a candle close. To identify a flip, track the price action from the moment the order block is mitigated until this candle close occurs. 3. Fair value gap formed by a valid order block. The gap and the order block that created it confirm the flip. This shift from the previous order block to the new one is what we call a flip. If any of these components are missing, you're probably just looking at a retracement, not a true flip. Now that we understand the flip concept, we can use it to efficiently identify decisional order blocks, spot more precise and higher probability order blocks on the higher time frame, and even detect professional-level flips in action, which will be explained in the final section of this video. Now let's go through a few real chart examples so you can clearly see how flips appear and how to use them to your advantage. Section 2. Flip examples. Let's take a look at a bullish flip on the chart, which gives us a precise decisional order block to trade from. If you're looking for a precise decisional order block, it's better to track the flip of the last order block that was created by a break of structure with a full candle close, not just a shadow. Price breaks above that order block with a candle close. This confirms that the bearish zone has failed and the market is ready to shift bullish. A fair value gap forms as price accelerates upwards. The order block that generated this gap now confirms the flip. This new bullish order block becomes our decisional zone for high-probability long entries. Enter a long position at this order block as the flip is confirmed. Place the stop loss 2 pips below the entry point. Note that this 2 pip stop is specific to euro-dollar, and set the take profit at a 5-to-1. Let's take a look at a bullish flip on the higher time frame. On the 15-minute chart, a bearish order block is mitigated. Price eventually breaks above that order block with a candle close, confirming that the bearish zone has failed. A fair value gap forms as price accelerates upward. The order block that generated this gap confirms the flip. This new bullish order block becomes the zone for potential high-probability long entries. To trade it, wait for the order block to be mitigated. Then move to a lower time frame, the entry time frame. After the break of structure and the formation of the fair value gap, enter a long position at this order block. Place the stop loss 2 pips below the entry point, and set the take profit at a 5-to-1. By following these steps, you can clearly see how a flip signals a change in market control and opens up precise, high-probability trade entries. Section 3. Advanced flip. In advanced flip, we use a combination of higher and lower time frames to identify more optimized and higher quality trading opportunities. First, wait for the higher time frame order block to be mitigated. Once the break of that order block is confirmed with a full candle close, extend the order block rectangle until one candle after the candle that failed the order block. This extended range defines the precise boundary of the higher time frame failure. With this extended boundary established, you can clearly determine how far you should track the flip on the lower time frame. This ensures that you focus only on the correct window where the transition from the old order block to the new one takes place. On the entry time frame, the valid area to search for the new order block begins at the moment the higher time frame order block is mitigated and continues up to the close of the candle, that is one candle before the end of the extended rectangle. And the close of this candle is exactly the same close as the higher time frame candle that broke the order block. And finally, the order block that forms within this window and causes a shift is the new order block that flips the higher time frame order block. By applying this method, you combine higher time frame context with lower time frame precision to identify professional level flips and more reliable entry zones. Section 4. Advanced flip examples. Let's walk through a bullish advanced flip to see how the higher and lower time frames work together. On the higher time frame, price returns to a bearish order block and fully mitigates it. Shortly after mitigation, price breaks this order block with a strong full-body candle close. This confirms that the bearish zone has failed. We extend the rectangle of the higher time frame order block forward until one candle beyond the candle that performed the break. This gives us the complete range where the internal flip must occur. Moving to the entry time frame, we now focus only inside this defined range from the moment of mitigation up to the closing point of the extended rectangle. Inside this window, price forms a bullish order block that creates the actual market shift. This is the order block that flips the higher time frame zone and becomes our valid long entry area. This approach gives you a precise and highly reliable bullish flip with a clear, optimized execution zone. Bearish advanced flip example. Now let's review a bearish advanced flip using the same methodology. On the higher time frame, price returns to a bullish order block and fully mitigates it. After mitigation, price breaks this bullish order block with a candle close, confirming that the bullish zone has failed. We extend the higher time frame order block rectangle forward until one candle after the candle that delivered the break. This creates the exact boundary where the flip must develop. Switching to the entry time frame, we analyze price action strictly within this boundary, from the mitigation point until the close of the extended rectangle. Inside this area, the market forms a bearish order block that generates the shift. This is the order block that flips the higher time frame zone and becomes our valid short entry area. This example demonstrates how a bearish advanced flip provides a clean and objective framework for finding high probability short setups. If you found this lesson valuable, make sure you subscribe to the channel and turn on notifications. Your support helps the content reach more traders, and it ensures you never miss the high-quality lessons coming your way. See you in the next lesson.